Welcome to another episode of The Fuel Line. I'm Farid Ahmad. I'm the CEO and President of Dealer Solutions. Today, we have with me one of my business partners, Maxime. Why don't you introduce yourself?
Good afternoon, Farid. Hi, guys. My name is Max. I'm the managing partner at DSMA.
So today we had some great feedback from our last podcast and lots of questions. We could only go through a few, but the questions today are really surrounding our financial services and what support it provides and what benefits it has for our client base. So, Max, can I ask you the first question? Sorry, I wrote it all down.
You have your glasses. Are you going to read your notes?
Oh, my God, I lost my glasses. So the first question this viewer sent in was, Max, what are the benefits of an evaluation, and how do we, DSMA, put value in evaluation?
Yeah, very interesting question. The benefit, I think, of getting evaluation by a third party is it's unbiased, it's independent.
Good point.
I think as business owners, you're emotionally attached to your assets, right? So you're very emotionally attached to your dealership, your property, your, everything you've built, your employees. So it's more than just a business. So getting this third-party assessment really removes that emotional aspect from the valuation. So I think number one, dealing with a reputable firm that has the data. In our case, we've built a tool called Quotas. And as you know, we've been working on this tool for about 6 years now. And we've got 50 million data points. And basically, when we run a valuation, we run through a lot of data points. It's not one of those, I think it's worth X, like we see a lot in our industry. But no, so it's based on data, and I think that's really why. The how, you're asking about how we conduct our valuation.
Or how do we put the value in valuations?
Put the value in, that's a good question.
Great question that guy asked.
Yeah. Especially these days, as you know, Farid, and we talk to clients all the time, the industry's shifting. There's new players. Right. The economy's not where it was a few years ago. Most dealers were really profitable during COVID and kind of surfed that wave for a couple of years. And now reality's coming back in. And so we have to change the way we conduct our valuation as well. And, one of the things we have to do now is go back further in time, where we used to always look at 3 years rolling. Now we're doing 5-6 years.
Yes, I know.
Buyers are asking, hey, this story's done great during COVID. What was it doing before COVID? And what is it doing this year to date? And I want to look at that trend. So we got to adapt, and that's how we've been adapting. Yeah.
Well, actually, you know this person. I won't tell you the person's name online, but one of our clients actually wrote it. And they said, I really think it's important that you mention, and they said their name, which I shouldn't say, that one of the true benefit of you, Max, conducting the valuation of their business, that they truly feel, had they not gone through that valuation process, they truly feel that they would have only got half of what they thought their business is worth. How often do you hear that from people that do evaluate? Like, what is the response when we present valuations to our clients? Maybe you could share some of that.
Yeah, no, it's a good question. I you know what? It's a little bit all over the place. We've got a couple of clients that will be in that range, but I would say more often than not, we come in higher than their expectation. And really? I think the reason is, a lot of people in the industry will talk about the multiple and the goodwill and the profitability. But really, are you comparing apples to apples? And are you fully understanding the specific asset you're looking at? So we've seen many cases where the value came in 20, 30, 50% more, like, this gentleman here. So I would say getting that advice up front and making sure you understand everything that may impact the value of your dealership. And there's a lot of intangible, and I'm afraid maybe you want to share with our audience, what are some of the things, because, my background's more accounting and I look at the numbers all the time, but you look at all the intangibles. What are some of the intangibles that have a real impact on the value?
Well, I'd say the greatest intangible would be real estate, Max, and the condition of that real estate. Right. If a buyer's looking at buying a dealership and the store's not imaged, most manufacturers, as you know, are pushing this agenda that they're looking to have their stores imaged. Well, that's going to have an impact on the value, because somebody's going to look at your business and go, I may have $2 to $5 million of leasehold improvements that I got to do that, so I really can't pay the full value. So that's number one. Number two would be salaries to owners or to family members. You know, sometimes we think when we're doing the valuation, well, that's just the cost of doing business. Well, it's not always the cost, as you well know, right? So that can have a real impact on businesses. I think depending on your trajectory, some people you could say, well, listen, my business is firing on all 8 cylinders and it's just rocking and rolling. Well, that may not necessarily mean that you're going to get a higher multiple, because some people as buyers are looking at, where's the upside? If I pay this amount of money, how do I pick up the extra money, right?
They see risk, right? They only see down.
Exactly. And on the reverse side, if it's losing too much money, why would I pay so much money? So I think those are the most common ones, I would say.
Yeah. No, interesting.
So can I ask you a question now? Okay, another question. What are the typical things that people don't account for in their normalization of their business?
Well, let's start by defining normalization. Maybe we should start there. Basically, what we're trying to achieve when we normalize is we want to bring the earnings back to a comparable measure. Right?
Okay,
So
that's a good word, comparable.
We want to say, you know, if you look at a specific dealership and you remove all of the, you know, items that are specifically related to that ownership structure. So I'm going to give you some examples. So, for example, a lot of our clients are family-owned businesses, right? And so you would see very often where family members are involved in the business. Sometimes they're actively involved in the business and they're playing a major role. Sometimes there's people on payroll that are not actively working for the dealership. So that creates expenses in the dealership that is not really reoccurring if you look at it from a normalized point of view. So I would say looking at family members, shareholders' compensation is always where we start, and there's usually adjustments there that are necessary. The second one is the real estate. You pointed out real estate. You know, we're seeing in some markets across North America where, you know, especially metro market, the real estate is becoming a real challenge. Why? Because supporting a rent factor in some of those property values
that have appreciated so quickly, right?
And, you know, for a business owner, you look at the value of your dealership and there's a value for the business, there's a value for the real estate. If the value of the real estate is higher as other use, for example, you know, you're sitting on this property and you see condos all around that are building, and we see that in many cities. Well, maybe it'd be difficult to support that rent factor for a dealership business. So that's a challenge. So looking at that proper rent factor and identifying for the owner how are they going to maximize that value? Is it in the real estate, in the operation? Can they do an hybrid? So we always spend a lot of time in the real estate aspect, and that's why we also own a real estate firm.
If I can ask you, sorry for interrupting, but what are the most common things people leave out when they're considering information to give us that impacts their normalization? Would be things like life insurance and...
Yeah, you know what? That's a good one. Sometimes there are assets that are on the books that they, you know, they've been on the books for so long. They, you know, for example, life insurance is a good one when there's actual value there. There's sometimes investments in other companies.
Yes, I've seen that.
Right. Through entrepreneurs, and so they may lend money to other businesses. There may be investments. So there's a lot of work to be done on the balance sheet, but I think so many people just focus on the profit and loss and look at the profitability and the KPIs. There's really a lot of work you need to do on the balance sheet to really understand where the value is.
Yeah. Interesting, hey? Yeah. So another question that I got, and I suppose this is on the forefront of a lot of business owners, forget car dealers alone, is interest rates. Yeah. You know, we saw during COVID historically low rates, which most probably will never come back unless there's another disaster. But those rates rose very quickly. Inventories balanced out, the chain supply got resolved. Where do you see interest rates going in from DSMA's perspective? And what impact do you see happening on the business?
So, you know, right now what we're seeing is the US probably going to start reducing their rates very soon. Canada's already started to reduce. So they're sending a signal in terms of percentage of points is not much on your actual loans, but it's a good sign it's coming down. The actual impact is mostly on the lending side, right? So most of the M&A deals are being financed with traditional lenders. And so those lenders have been a lot more careful. As you know, over the last couple of years, I would say they've really are more careful. They're looking at, balance sheet cash flow. They're looking at debt coverage ratio. And so you're ending up paying a little more for your loans. So, I think a lot of people are hoping it's going to continue to decrease, and everyone's still hoping for a soft landing of the economy. But you see, everyone's really on the nerves. You saw the stock market the other day plunged 10% in one day.
No, that was crazy.
So, it's hard to predict the future.
Did you lose a lot of money?
Let's not talk about that.
Okay.
Yeah. What do you think? Where do you think we're going?
It's an election year in the United States, as we all know. And I really thought, because it was predicted, and I don't know if it's going to happen now, that in September there was going to be another interest rate cut. So I'm not sure if that's going to happen anymore based upon the last week's news. You saw what happened. The stock market crumbled. So I still believe there'll be a rate cut in September. But I got a feeling the next 12 months will be pretty flat on rates. I don't see much rate decrease. Now, it will depend a lot about who gets into the White House, but who knows. Hey, thanks for taking some valuable time out of your life to watch this podcast. I hope you're enjoying it. Please don't forget to share, like, and subscribe. And keep the questions coming. They're very helpful. Thanks very much.